Well, okay, here we go. I was going to share a little anecdote, and I did speak to Sam Zell. It's an incredible burden to follow Sam. I actually spent 9/11 with Sam after the second building fell down, negotiating for about 3 hours, and we were reminiscing earlier. And it was a deal that was surreal because the world was ostensibly falling apart. My kids were all over the place, but I was able to reach out to everybody in my family. And we were in really deep into a transaction. And it was Sam, myself, and one other person who were really the primary speakers, but it was really surreal because it allowed you to escape all the horror and terror. And yes, in fact, Sam remembered, and it really was a deal that should have been done. It wasn't done. Had nothing to do with 9/11, but it was surreal. In any event, good morning. My name is Jay Neveloff. I am the chair of the real estate practice at CRE 11, and that's my introduction. Let's go down.
Okay. I'm Kim Hurahan. I'm the CIO of Real Estate Investments within CBRE.
I'm Eric Newman, Treasury Manager of the City of Stamford. We have also serve as a trustee on several of our pension and retirement plans, both in Stamford as well as the town of Fairfield.
Hi, Billy Butcher, the Chief Operating Officer of KKR's real estate business.
Ed Owens, I am the CEO of the County Employees Retirement System in Kentucky.
Okay, so here's the deeper dive, and this is the question that I'm sure that every one of us is confronted with as we're talking to our real estate colleagues. What's going on in the market? Where's the market going? With interest rates rising, what does that mean? So for all of you, and you're either investors or in one form or another, or users, I'm going to start off at a high level. Where is the market? Are you investing in real estate? What are you doing? Are you watching? Are you investing? Is this your market?
Okay, I'll go first. So we're trying to invest. Not a whole lot on the market. It seems as if there was, at first, let's just take the summer off, quote unquote. And now it seems to be, we're doing our 2023 plan, so let's see what 2023. I don't think any of us know really where things are. Interest rates obviously affect us greatly, and cap rates for sellers are different than cap rates for buyers, and there's a disconnect there, and there's just not a whole lot in the market.
For us, from a pension point of view, we're continue to stay invested. We have allocations. We're experiencing with some of our private stuff the denominator effect where our public equities and public securities are now down, and our allocations to illiquid assets are suddenly reaching up to that tipping point, which then technically will trigger, us to reduce, gain our numbers back lower if it is more extended. From a city perspective, we have development going on, but at the same time, you always have, with the rising rates, there's going to be a slowdown, both internally with the supply shortage of gained workers to complete the stuff, as well as the supply chain issues. And at the same time, we're going out and raising money, as we do every year, and we're paying a lot more now than we did not too long ago. So we've gained both ends. So we have assets coming down, but then your borrowing costs are going up, and as well as other building projects costs, so challenging.
Billy?
So the biggest impact spot right now for us is the shutdown in the real estate debt markets. I mean, obviously the CMBS market is all but closed. The big bank lenders are all but closed, other than for refis or for their couple of most strategic opportunities. And so that has really obviously chilled the transaction market. What does that mean for our business? Selectively, where there are transactions that come with debt in place in sectors that we think have great long-term trends, we're still investing. We are heavily pivoting, though, into credit and being a provider of that credit. Our business, we're approximately $63 billion of capital under management today, and it's about half equity and credit in the real estate space. And so we're most active as a lender right now, filling some of the holes that have been left by the more traditional and larger real estate lenders that are out of the market, at least on a temporary basis.
Jay, just a minor point of privilege. My friends will ask me what really happened to you in the last 20 years that's really funny. I followed Sam Zell on a stage, and the people in the room had to pretend as though they cared about anything that I said. Well,
That's a big burden.
yes, really. We are what Mr. Zell described. We're that long-term investor who can pretend for the first 15 years that it didn't work out, but we still have 10 years left. So where we are, every asset class has really improved. Given the last year, what's gone on with equities, our 10-year return expectations are higher in equities, higher in the bond market. So we're in a position where we really are wait and see. Let's wait and see when some of the marks are made in the private space in real estate to see how we go forward. We, like every institutional investor, has the capital to do it, but we're in a position where we want to wait and see.
This is a question for you and Eric, and it wasn't something that's on the outline, but if you had a crystal ball and you're looking 2 years ahead, do you think your allocations to real estate investment changes? And if so, how do you think it changes? It's an unfair question because this wasn't planned at all, but it's relevant.
I'd say we're going to continue with our allocations, whether the asset allocation within the real estate mix will change. We're constantly looking at that, things that might be, it's your entry point. If you're not going to be fully out of it, it's a part of our long-term allocation to our portfolio management strategy to get better long-term returns is to have a diversified portfolio. So we have our retirees down 30, 50 years ago, they're able to retire with payments. So we're going to constantly look at that. Real estate has always been historically a great asset class. It goes through its cycles, goes its ups and downs, but then you have the cash flow coming in that pays pays our monthly payments to our retirees. Other things we're going to be looking at in the short term, we might go into more opportunistic real estate opportunities if it's a bigger slowdown. You're going to invest in those strategies. It's about getting in at the right price and in the right vintage. So if you constantly say, okay, we're at the peak, we exit, we're not going to go in for another 10 years, you're going to miss the next run up.
Ed, how about you?
Yeah, I really see over the next 2 years the real estate allocation going up. If you look at what's happened in the secondary market and the number of, as Eric mentioned earlier, the denominator effect that is causing a lot of pension funds to divest of real estate holdings because they're over allocated to the space today. We happen to be underallocated real estate, so it looks as though the denominator effect has helped us look as though we were right on target. But I do see us looking for strategic opportunities in the real estate space, given the returns that are there. And we've talked internally about our desire to look for the right opportunities. But again, Jay, we're going to go slow with that and make sure that the opportunity we have is the one that we want.
Yeah, listen, every indication I have from people that I'm speaking to is that they're not changing their allocations right now, but they're looking at increasing the allocations. Some people will say they find, in a sense, more stability in a real estate sort of investment, whether it's a mixture of debt and equity, and that allocation. So I think that's interesting. Billy or Kim, do you see that trend also, or do you see it differently?
Yeah, it's the institutional investors we're talking to as LPs, we hear often denominator effect right now, so slowing capital allocations in general. But when you think about what you want real assets to be as a percentage of your asset allocation in a macro environment that feels like you're going to have a higher resting heart rate of rates and inflation, real assets, if anything, are going up as a percentage, not down. So that doesn't necessarily mean they're fresh dollars being committed in scale spot today, but when you think forward a couple of years, it seems supportive of that. With our own balance sheet, we have a substantial balance sheet as a firm, and our allocation to real assets has gone up. Infrastructure real estate are the highest conviction opportunities in this environment. You look back, we look back over 42 years or so of data around the core real estate sector, and in the periods where rates were rising, real estate returned about 12%, and all other periods 8%. Now, why is that? You've got two things going on there. Obviously, there's the rate rise, which is bad for cap rates, bad for real estate, bad for capital markets, we just talked about. But obviously, there's the income effect that takes place over the following 5 to 10 years, of generally accompanied by higher inflation, where real estate then should shine. So that's all to say, yes, we look at this and we say we're in this period of volatility. It's going to be messy. It probably is going to deter some people from entering. But if you think about the outlook over a 5 or 10 year period, real assets should be a good place to be hanging out with a longer term lens.
Kim, what's your view?
Yeah, I mean, I agree with everything Billy was just saying, and we're seeing the same thing, where our institutional investors are saying, okay, denominator, but we like it as an asset class. I've just been watching it go from 0 to 5 to 10 to now maybe 15. It's an important part of anyone's portfolio. And so we're going to continue to see an upward trajectory, I think, in real assets.
So let's let's be a little bit more short term now. We're all in agreement for sure that the debt markets for the big bank lenders shut down. CMBS shut down. What happens in January? When does it open up? Is it everybody, just like in the summer, they said, yeah, I'm taking the summer off. And now clearly a lot of lenders closed for business this quarter. This quarter's done. And yes, there are alternative lenders that are very active, like KKR and other funds that have the money. What happens in January? When's the turnaround?
I think it's when the Fed starts reducing their increases. I think that's when people start to feel like they
reducing the amount by which they're increasing.
Right. So going from 75 to 50, or to 50 to 25. I
So
think
that's going to be pretty soon. I think
the markets are waiting for when does it start to decline.
Okay.
So I think there's a measure of that. And look, there's a lot of capital out there, and people are going to have to invest at some point. And that's just going to create this situation. So, is it 6 months? Is it 9 months? Is it a year? But I think we're all waiting for the Fed to make a move, and then you can at least say, okay, now here's where the long-term projection is. I'm either going to do debt now or I'm going to wait. And how long do I need to wait? So you're just doing those calculations.
Billy?
If you unpack what's the cause of the current debt shutdown, right, and take it from the commercial bank side first, banks were incredibly active in real estate last year, so loan portfolios swelled. With the rise in rates, a lot of other portfolios at banks, in particular their fixed rate, fixed income portfolios or bond portfolios, are down heavily, creating equity destruction, capital hole. And so then you have their regulators coming in and say, okay, your capital ratios are off. You need to rebuild equity. And oh, by the way, you're basically a denominator effect of the banks. You're over allocated to real estate. So I think for that to unwind, I think that needs to unwind in order for the banks to come back into the real estate lending market. So what is that unwind? So to some extent, it's time. It's time and retained earnings. But I think you're going to have another leg of destruction here of value around, in particular, the office sector. I mean, I think as soon as this quarter, you're going to start to see some real keys being turned back in the office sector. It's going to create further write-downs on loan books and further problems for some of these large lenders where office is a big portion of their books almost universally. So I think it takes some time. And then the CMBS markets obviously are somewhat independent of that, but more tied to, I think that's a little bit more of the Fed, broader securities market sentiment, and finding some terra firma on like where do rates top out before securities markets come back. But I think the commercial lenders, it's a little bit of a longer road, and the Fed, in part because it's consistent with what they're trying to do broadly in their macro policy, but are being particularly hawkish right now as regulators of these commercial banks, it seems, with memories of 2008 probably still bouncing around heads, and wanting to protect at all costs against an over-leveraged event, which I think they're doing a good job of protecting against. I don't think we're anywhere near that type of level. But I think as a result of that stance, it's going to take a while for banks to open back up.
And I think, we can't forget about the life companies, right? They'll be the first ones back. And they'll be the first ones just sort of saying, okay, we've got to we're collecting all this money on our premiums. We've got to start putting it to work.
Listen, I think that's exactly right. But does it mean that the life companies, for example, could go in, but it has a tighter LTV? It puts money to work. They're protected. They're going to get a higher rate. And what happens? Where is that activity? And
Yeah, I really want to go back to what was said about the Fed and really to push a button on what Mr. Zell said about fiat currency. Until there's some balance or until there's some revelation about what will happen with currency, what will happen with the strength of the dollar versus the rest of the currencies around the world, I'm not sure that you're going to find many people who are going to rush back into the credit market. So I think there really will need to be some settling out there of what ultimately will happen with the currency.
do you think there is? It's certainly not as much, but is there enough money from alternate lenders, from private equity funds, from sovereign wealth funds, from family offices who are going into debt? Will that keep the market moving? I don't know what's going to happen with CMBS. I don't expect that's going to bounce back as quickly. My own bias.
No. No, I don't. I think in order for a really functioning real estate credit market, you need the lowest cost providers to be there. I mean, you look at why isn't CMBS working? A big reason why the CMBS isn't working is because the big buyers of the AAAs are the banks. And so AAAs have widened out from something in the low 100s to 250, 300. That does not work. And so I think you need the lowest cost capital providers, i.e. the banks and the life cos, but the banks in particular, to be back in the market for it to be functioning the way we all
I
have
want
become
to ask
accustomed.
the four of you about CMBS. And again, this wasn't planned, but it's occurring to me, and I have my own biases. In CMBS 1.0, one of the difficulties is as the market turned, you had the challenge of getting the loan into the hands of the special servicer. The servicer wanted to hold on to it for as long as possible, couldn't make a decision. The special servicer, once it gets there, doesn't want to let go. We're starting to see the same challenges. Not yet, but we're starting to see the same challenges. What happens to CMBS 3.0, given the challenges of finding somebody and speaking to somebody on the phone and saying, I've got this situation, I want to work with you, maybe we want to do a recap, we want to do something. What happens? What is the future of CMBS 3.0? Philosophical question.
I hate to say it's probably not going to change, but it's probably not going to change.
Because the rate's lower.
Yeah.
The rate's always going to be lower.
Yep. And people put up with I think we're eternal optimists in the real estate side, and so we say, oh, okay, well, we can work our way through this and it'll be fine. And then when it's not and you can't reach anyone, it's a problem. But it's all so entrenched that I don't see it changing. I don't see a 3.0, frankly.
From our perspective, it's like part of our allocations. You're going to be in there, and you're not going to time it, even though it might be liquidity, might be going down in price. We still have allocations to it, and we're going to continue to have allocations because when it does recover, when things change, we want to make sure we're in the market. And that's because we're long-term investors. We have a very long time horizon. We're not looking at, we don't have to make reportings of quarterly reportings. We had to make sure that we have our funds 30, 50 years, 100 years out. And so it's a different view that we're taking.
Did you want to add anything?
No, I agree with that. It really is a long-term view, but I really think that pension funds tend to, because we do have that long-term horizon, tend to be a bit of lemmings and followers in terms of what our peers are doing. So we have very similar asset allocations. We move similarly. This is one area where I could see divergence. I could see some taking the view that we don't see CMBS changing, even though we may have had a historical allocation there. Maybe we take that allocation someplace else because we don't see it over the next 5 to 7 years as being a market that's going to return much force.
I guess the premise of the question that's got to change. The last change was there was a real problem, right? The last change there was a real incentive problem. There was a real risk management problem. I actually think that some of those changes have resulted in, and the collective institutional memory of the last crisis has resulted in a relatively constrained CMBS market through this cycle. So yes, we've had a dozen years of rising values. Yes, rising rates are going to change the cost of capital, and there will be defaults, but I don't think you have the same systemic problem this time that you had last time that precipitated that change. What you're describing of CMBS special services are hard to deal with, like, is kind of the way it's always been, and kind of a known, like, you know, built for speed, not for comfort, right, is the shorthand. And so it's like, okay, do you want to go deal with the CMBS market, or do you want to deal with a more friendly lender?
Because the owners made a conscious decision when they did a CMBS financing. They weren't naive or blind to the pitfalls and risks. And,
Yeah.
and they said, you know, saving 70 bips was more important to them than you know, and they'll figure out a way to get to the special servicer. They'll figure out a way.
Yeah.
Because we're all smart, we all friends, and we all know the bars to go to in Charlotte.
So I think there are going to be frustrations, but I'm not sure it doesn't rise to the level of like, hey, this is broken, we need to completely overhaul it.
Okay, let's come short term now. So, equity holder needs to refinance. It's just the practical realities, and what I'm seeing, and I believe that the next wave of work for law firms is going to be recaps. But even if you have a recap and you have to refinance, you still have the rate market being upside down. How much help are rate swaps right now? I'm going to give you the rate swaps are insanely expensive, right? They're insanely expensive, and I don't remember the numbers, but a rate swap for $50 million today is more than 10 times, maybe 20x what the cost was a year ago.
Jerry, you're talking about like caps?
Caps.
Caps, yeah.
So what happens? How does this all play out? Debt's coming due. Lender likes the sponsor, and sponsor says, I either have to dip into my pocket and put in more money, or I've got to get somebody to come in and do a recap.
I think it depends on the asset class, and so said another way, I think what you're seeing that dynamic happening right now in commodity multi-tenant office, and it's resulting in a lot of borrowers saying, I'm not coming out of pocket for that, and here you go, lender, have at it. I think, you know, for assets that have a brighter future, people are having to come out of pocket and buy that go-forward interest rate protection. If you have a requirement in your loan docs of a cap at a certain amount and that's maturing, you got to go buy the new cap at the new price.
And for everybody's benefit, I'm going to share a conversation I had with a client years and years ago. It actually was a multi-deal, and the deal sucked. The deal was a terrible deal. And I said to the client, which is a PE fund, what are you doing? Why are you looking at this deal? And he said to me, and it was really true, and I was just learning at the time. He said, where I'm going in the stack, I'm good. The money that's going to get lost is the sponsor's money. I'm good. I like where I am in the stack. And that was a very profound and simple and obvious lesson. So I'm just passing that on because it was really true. And a lot of what we're seeing, what we're doing is representing money going into the stack, and they're perfectly fine where they are. So just an aside to what's going on. Is anybody else seeing recaps really, and I don't know that Ed, you
Yeah.
would see it where you are. But Kim,
Yeah, I mean, there's talk of it. There are some pension funds who are thinking, all right, we need cash. The CIO saying we need cash. Real estate, maybe logistics, that seems to be liquid, or multifamily seems to be liquid. We hate the thought of selling it, so maybe what we'll do is we'll sell off a portion. But you know, I mean, frankly, there just is so little discovery right now. There's a lot of talk of doing these things, and then they start talking to people and they don't like the pricing. And real estate's about legs, and we're institutional now. And so many people just have the cash to hold on. And it's just office is the one thing that people are saying it's not worth holding on to if you have commodity office. So, I mean, yes, I think there'll be more, and I think it's a good point, but people aren't ready to pull the trigger yet if it's really painful for something that's good, that they like. They like logistics long term. They like multifamily long term. Whatever the asset class is that they like, that's the liquid one, and that's the decision they're making.
But I think what you're describing, Jay, is coming. I mean, I think this is the next 9 months. You're going to have a lot of people who are out of cash, have good assets that are worth more than par. The capital stack needs capital. They don't have the capital themselves. They need to go source that somewhere else, or there's an option. And so when you think about, like, when I say we're lending, what are we lending to right now? Because the transaction market is fairly slow. And so a lot of what we're lending to are these gap capital needs. You know, it's someone has a 65% mortgage, can refi that at 55%, has a 10% gap, needs to fill that. We can step in and be that bridge.
do you do that as mezz or
As mezz, or preferred if it's behind a CMBS loan or something that doesn't allow for true mezz. But I think you're going to see more and more of that, and then people who don't want to trade the asset, don't want to trade the 100% basis, don't want to take today's price, want to can stay in it, but you know that gap capital, that refinance capital ends up being some sort of hybrid debt equity type instrument.
Listen, I totally agree with that. We keep on talking about office. Let's talk about sectors for a second. So, multi is popular, logistics popular. What's going to happen with office? Who's going to invest in office? There are office. Actually, there was just an opening of a building in Hudson Yards in the past week or so. There's new offices opening. What's going to happen with office? What's Midtown New York going to look like as the buildings on Park Avenue, Fifth Avenue, Sixth Avenue? What happens to that market? Who's going to invest?
Yeah, I mean, so we're all in an office, right? And Sam was talking about,
That was great.
can't
What Sam
mentor
said about the
on
office,
Zoom
I wanted to
and-
applaud.
yeah. And look, I mean, for every asset class, there's always, when you hit bumps in the road, there's always the flight to quality. We always say this. And this is going to be true in logistics, too. I mean, you've got robotics, and you need a certain thickness in the floor. And if you don't have it, you have a problem. And so office is going through the transformation that retail was going through over the last 10 years.
And
right?
still going through.
And still going through. But there's going to be a flight to quality. There's office that people want to be in, that they'll pay anything to be in. And so I think office is a good asset class. It's just you need to sit there and say, okay, what's attracting tenants and why? And is this building going to kind of go through the test of time? But we're going to see that flight to quality. I don't know what you do with the commodity office, as Sam was saying, nothing. I mean, it's so deep, you can't put it to multifamily unless you have a very sort of long, thin building.
And that's
Yeah,
even
it's-
tough
there's
because
gonna
that
be a
doesn't.
lot of
You don't have windows.
There's going to be a lot of pain, but then the economy gets better. Then people are coming more to the office. There's all kinds of, and then you start the whole cycle again. But office has forever shifted, and we just need to shift with it.
So even demographics are changing. People might, this might be starting their career remotely, and they realize that they don't have, they want to be in an office, to get developed and meet your colleagues versus on the screen where it's all just flat. And then other companies will say, okay, we collaborate better when we have people working together in person, and you go to board meetings, and when we're on the screen, you never pick up everybody's real expressions. Everybody's looking at the screen. But when you actually go back into the boardroom and you have your side conversation, so you always have that type of aspect. I think it's going to come back.
Eric, what's happening in Stanford? What in terms of development? I remember a time where Stanford office was in vogue. Everybody rushed to Stanford. Then, at least my perception is, that wasn't as hot as anymore. It cooled off. What's going on now?
Continue having more companies are coming in, whether it's headquarters or it's hard to tell from where I am because you're not necessarily seeing inside the buildings who's actually moving in. The trains are getting more packed every day, which is a good sign. For
The trains for people coming
in, right into it. So that's getting much better. And then over time, people are not necessarily going to want to stay in their homes 24/7. You want to have that divide where going to be in office and I go home. Otherwise, you end up, working a lot more hours. I think become more efficient because you might work different hours. But it all depends. If you're a global organization, you could get talent around the world where you're not necessarily looking for that next job in your region, in your city. You could say, okay, I'm going to have that hybrid thing where I might go into an office once in a while. I might work remotely. I might be on a plane where I need to see my colleagues in another.
Listen, I love Sam's quote, which was, "It's hard for me to motivate my modem." Ed, what are you seeing?
Yeah, just from the office space, what Mr. Zell said was absolutely correct. Newer offices, great amenities, going to be fine. Central business district, office buildings, no amenities. The cost to convert prohibitive. They're going to struggle. So I do think it's going to be very hit and miss. But if I could, Jay, I'd like to, because everything that I've said, I've basically just pushed a button to say, remember what Mr. Zell said. But I do want to speak to something that he didn't say differently, but I do have a different point of view on single-family rental, if we could.
I actually thought that was fascinating,
Yeah.
and Roger, who's the conference coordinator, was sitting next to him. I said, that was really fascinating what he said about the single-family rentals.
Yeah, if I could, yeah. So I took a position different from Mr. Zell on, so listen to me, right? He's very, very focused on multifamily and absolutely correct. I didn't hear him say that he was anti single family rental. I heard him say the jury was still out. It was going to be hard to be able to multi-jurisdictional management of that was going to be difficult. But there's 72 million millennials who, when I came out of school, I went to the city where I could get a job. Millennials today go to a city and say, I want to live here. And what single-family rental is doing for those 72 million millennials is it's giving them the opportunity to put off making a commitment to the city in which they live. So they can do single-family rental, and in one city, and in the span of when that lease runs out, I can go to the next city. I'm not committed. It really is something that I think will continue to gain traction and something that we are very focused on and very much interested in. So,
Interesting. Anybody else have any views on single-family rental?
It allows for variability. If you're in a good economy, you say, okay, I can make an investment into a house, and you're in a more challenged economy, you got to downsize suddenly. And if it means being in a rental, you're going to do that. You want to keep in a certain town. If you have school-age children, you made a decision to live in one particular neighborhood or one town with a good school system. It's hard to move, and if you can't afford it and you're forced to sell, if you're able to extend it by, say, being in a rental, staying in that community, because you might not have that resources to make that down payment, to make that equity commitment over time, then as well, you also have dynamics of family dynamics are changing, where you might have to go, you end up going two different ways, yet you want to stay in that, having a less impact on your children. So from a single family, I think there is going to continue to be that. And we're seeing in the town I live in, completely opposite. We have a lot of single families, but now we're seeing more multifamily development near transit-oriented districts, by the train station, where whether it's going to be partially affordable housing or more affordable housing, because with the real estate prices going up, but allows people to get space at a smaller space, whether you're an older person who wants to downsize and stay in the community, to go there, or somebody who's starting off their career says, okay, I grew up in this town, I can't afford a house that my parents have, but I could afford another type of unit, a different type of housing, where I could get on the train, or drive to my employer.
Billy, do you have any view on single-family housing? Is that something that KKR has looked at?
I think as a general part of the housing ecosystem, you're going to see increasing single-family rental by individual homeowners. So if you just think about what's going on right now, there's going to be less mobility in one's ability to sell a house and buy a new house, given the incredible increase in the cost of mortgages. So if you have a 30-year mortgage in place at 3%, and the proposition of getting a new mortgage is 7%, that's a very sticky proposition. But for life reasons, one needs to move. I think you're going to see more people with homes renting out their existing home and renting a new home in whatever location they're moving to. So I think as a general matter, you're going to see more rental of single-family houses from non-institutional ownership as well. It just, in many ways, makes sense given the buy versus rent relative affordability math, as long as mortgage rates remain elevated, which feels like we're going to see at least in the near term.
Billy or Kim, I want to change the topic a little bit. I want to talk about what's going on in the market today. What transactions are there? I shared my experience that I think there are a lot of recaps going on, but there are still people kicking the tires, people looking at single asset and portfolio deals. Whether there's still a mismatch between asking and offering is certain. But are either of you seen big transactions that are still being negotiated, notwithstanding that the debt market's upside down?
Yeah, I mean, as we were talking about earlier, there's just fewer transactions out there. But a lot of the buzz this summer was the all equity buyers are out there. And there were a lot of all equity buyers, and they didn't have to deal with debt, and they thought they were getting a good deal. They're taking a long-term view and thinking about that. So those were out there. But I think even all equity buyers now are sort of retrenching a little bit and being more picky. I asked Chris Riley, who runs CBRE's sort of industrial practice on sales side, are cap rates changing? We ask these questions all the time. What's going on? And he said the last 30 days, he kind of sees an uptick 50 bips. And there's one transaction that Blackstone's selling. The whisper price was a 4.75 cap. And I guess this is good news, that it's going off at 4.25, but that could have been 3.5 a year ago. So
you hit a point that I wanted to touch on and share with people. What I'm seeing, we all use the phrase flight to quality. What I'm seeing in the market is there are some really prime assets in all asset classes, but prime assets that family offices, deep pockets, potential buyers who don't have a 5 to 7 to 10 year time horizon, who have a longer view of it, and can navigate the debt market. They're in the market, and that speaks to what you said, Kim, about fewer buyers, but there are transactions. There are portfolios. There are these one-off, because there are pots of money that are absolutely enormous. And they view this as an opportunity to take advantage of the market.
Definitely. I think we get every once in a while now get unsolicited inbounds from these unlevered buyers of what you're describing, or from a family office type buyer with a long-term horizon saying, hey, if there's an opportunity to buy something at a just good per pound price and live this for 20 years, now is the time to be doing that. There is also a robust, to be overstating it. There is an active market in smaller transactions in the on-trend asset classes, so rental housing, industrial, self-storage, where transaction sizes just aren't that big so that there's financing available. And obviously financing for the smaller deals is a lot cheaper than financing for the bigger deals. You have the regional banks, not the big money center banks, but the regional banks who still will participate in those and can lend. You have non-bank lenders such as ourselves or our peers who are lending to those deals. And so if you're talking about asset sizes of 50 to 200, that's a fairly active market, and
It is.
we're sitting there tracking and saying, like the assumptions, the underwriting you have to do is actually pretty darn aggressive relative to, I mean, it is, high single-digit rent growth for the next 5 years and exit at, 2021 type cap rates. So there is still, but to your point, the criteria of an asset, of a deal to fit, it's very persnickety. So if there's something that's a little bit off on it, it's out. But if it checks all those boxes, then you're getting the 475 guidance going to 4.25 for that small subset of deals. And then, I mean, you can't ignore like GIC buying Store. I mean, that is a very substantial transaction, and so there are those, I would say, more isolated examples, but there are examples of larger transactions still happening, and particularly if it all comes down to the debt right now. I mean, if there is in-place transportable debt, things are transactable.
Have any of you seen more activity in the hospitality space? I'm actually seeing, and I'm always scratching my head. I'm seeing hospitality deals. I'm seeing sophisticated buyers looking at hospitality because they think there's value. And yes, occupancy in New York, I heard last week, was in the most recent quarter or month 92%, which is nuts. And yes, it reflects the fact that there are some hotels that are still closed. But I see people looking at hospitality deals again.
We're very active in hospitality in Japan. That's probably a little bit off topic of what you're asking. By the way, as a total aside, Japan's an interesting market when you think about global real estate business right now, where it's very detached from the rest of the developed world, where rates remain 25 basis points for the 10-year rate, and you can still borrow at 1%, and it's a very healthy real estate capital market.
Why is that so different?
You've been trying to get inflation for 4 decades, and they finally have got 2.5% inflation, which is like at target, and it's really all driven by energy inputs. Mm-hmm. It's a domestically funded economy, so a lot of the worries that are facing the rest of Europe and U.S., they're just isolated from in many ways. And the lenders are healthy, and so things continue. And a little bit of inflation is good, not bad, right, as opposed to what we're seeing in the need for tightening. So that is kind of operating as a pocket that is a unique pocket, and especially given the weakness of the yen right now for U.S. dollar denominated investors, it's one of, in our opinion, the more interesting opportunities around the world. But outside, in terms of domestic hospitality opportunities, I think in the sense that hospitality never had particularly efficient debt markets, right? You always were lower levered, higher cost in the hospitality space, just given the nature of the asset class. And so it was a little bit less debt dependent. It's a little bit less of a yield asset, a little bit more of a fundamental cyclical asset. So I think you can cast an argument as to why rising rates are a little bit less impactful on hospitality. That all having been said, we're not in the middle of a lot of activity in the hospitality space.
Ed, do you see anything in that area?
No, we haven't had a lot of hospitality deals brought to us because that really isn't our focus. We are focused on looking at real estate, but in different sectors.
Do you ever does your fund ever invest in single assets, or is it primarily through feeders or other funds?
Oh, sure. No, we'll invest in single assets. We'll lend to single assets. But again, it is a matter of the right environment, the right price, the right structure. But we're certainly open to doing that, and we have, unlike others, a influx of cash. Our General Assembly has just given us $700-800 million above our ARC, and we have cash to invest. So we're certainly open to looking at specialty credit type opportunities.
Be careful, Ed. You're going to get a lot of phone calls.
No,
now.
I saw everybody worked up. So let me pause here and see if there are any questions. If anybody has any questions for members of the panel. Because
There was no discussion on industrial. It was glanced on, and I think Giselle also talked about the Amazon effect. Probably, Billy, you're probably good with that, or as well, CD side. What's your thought on industrial?
Sure. Yeah. On the Amazon effect, that is headlines, not reality. So, like, if you look at what Amazon's leasing in 2020, they had a banner year of leasing. In 2021, they pulled back significantly from the major markets. So, if you look at where we're investing in industrial, it's called top 15 industrial markets. 21, they were almost out of those markets. So, what showed up in the press in 2022 was a year-old news with respect to the big markets. What they did in 2022 was the pullback in those tertiary, secondary markets, which for our purposes was relatively insignificant. Yet 2021 was a great leasing year, obviously, for industrial. So what was happening, the other retailers, the Targets, the Walmarts of the world are still playing catch up on their e-commerce strategy relative to Amazon, who was way out ahead of that. And then you have the effect of all of this supply chain shift reshoring. So that's all to say, the industrial markets from a current spot leasing perspective remain very healthy. And I mean, you can see that in Prologis' earnings reports and everywhere else. I mean, would you want to be doing a lot of spec development right now and delivering and having to lease up? It definitely is more tender than it was a year ago, but it still is a very healthy demand-supply balance on the ground in industrial. Fast forward, I think the key question is how deep is what the Fed has to do in terms of slowing activity, and does that cyclical effect overwhelm some of those secular tailwinds on a temporary basis? That's hard to predict with precision, but then if you take a little bit longer lens of not just investing for the next year or two, but taking a 5 or 10-year view, and you think about assets you want to own coming out of whatever recession we have, industrial still feels like it has great tailwinds, and it doesn't feel like replacement cost is going down anytime soon. And so those replacement cost rents, those equilibrium rents, should continue to have good tailwind behind them. You're not going to get the types of rent growth you had the last couple of years, but we think it's going to continue to be a healthy and attractive subsector. The other factor, when you think about just like capital allocation, we saw this when retail went away. Retail was a massive sector. When you have all of the end capital allocators saying, okay, I want, pick your number, 15% in real estate, and retail used to be 30% of that, and office still is 30% of that. And as those become less and less attractive or less investable, people are allocating away from those, where does it go? And so I think, and you've seen that as a big driver, I think, of a lot of the pricing and fervor for rental housing and for industrial. I think that continues, and if anything, gets stronger on a relative basis on the backside of whatever dislocation we have.
Any other questions? Yes, sir.
Yeah, I'd like to go back to the single-family rental. Like Ms. Owens, I understand the problems in single-family rental because I think it's really a scaling issue from an efficiency perspective. But if you keep it small, like we're actually looking at a project in Louisville.
Yeah.
It's 50 homes. I think you can make tremendous returns because, like Mr. Newman said, said, a lot of millennials wanted to have a backyard, a small backyard, given what happened with COVID, to kind of get out of the house. And we think it's not a scalable strategy, but if you keep it to either a regional or even a specific city, I think it's a very attractive strategy. It's just not scalable. That's my opinion. Because like you said, you need 1,000 or 10,000 roofs as opposed to one or more. But on a small scale, I think it's a growing strategy that millennials seem to like.
Hard to argue with that. Any other questions? If not, thank you. Oh, one more.
Yeah, can you go into more on the retail side? Where do you see it going, and what's the solution? I mean, it's kind of a destruction of retail all over the country.
I'm going to defer to somebody smart. I can't answer that one. And
I mean, you look at Target, right? What they've done, as an example, or Walmart continues to sort of take a look at the landscape and pivot of how people are shopping, and some people just want it right away and they're picking it up on their way from work and they don't have to do anything and it's in their car, to being in the store. I think people are enjoying being in stores, and it's funny because there's nothing in stores. That's a problem. But I think retail isn't dead. People do want to touch and feel things, and you look at some of the better operators, they're doubling down on their investment in technology and other things. And I think they're just going to be further and further ahead, and it's going to be harder for some of the others to even catch up. But it's a little bit of a mystery as well. Just like Office, it's iterative, and it's a combination of everything, because us as shoppers are a combination of everything. We're getting it in store, we're getting it online. We're more impatient online. We want it 5 minutes ago. I can't believe 2 days. What? That's crazy. So it's just a matter of trends, but you have to cover all the channels.
all right. Thank you all very much. Thank you, panel. It was terrific.